Andrew, thanks for joining me. How are you?
My pleasure. Yeah, doing very well.
Mate, I think it's really awesome to have you on as a key expert in the financial planning space, but I'm sure everyone's wondering who is Andrew. Could you tell me a bit about, I guess, how it all started with you getting into financial planning and your journey today?
Yeah, of course, mate. So it's a relatively short journey in comparison to some of the other people that you've interviewed, but I guess give you a bit of background about myself and where I sort of come from. Grew up in the outer suburbs of Sydney, so at Camden Way, if anyone knows where that is. Grew up on a little farm there and sort of went schooling down there in St Greg's at Campbelltown.
They've got all the flying experiences up in Camden.
Yeah, they do.
I remember doing it once, actually.
Yeah. Well, that sort of ties into my story. When I was at school, there was two paths which I wanted to go down by. One path was either become a pilot, and I did do the initial flight down in Camden and thought about that. And the other path was to get into finance.
Right, that's a big two-world apart.
Yeah, they were very different. You'd be surprised actually when you look at like the skills required, they're actually quite similar, like very sort of numbers focused and procedural sort of focus. But yeah, I opted to go down the finance route, obviously. I decided to go into the wealth management or financial advice based off the role I was working at when I was in uni. Yeah. So I went to uni, did Bachelor of Economics, Bachelor of Applied Finance, and I found that my favourite part about what I was doing at work was, in fact, the relationships and customer service side of things. And I thought, wealth management or financial advice would probably be the right mix for me. Got in straight away. I was fortunate enough to, as a 21-year-old, become an advisor straight away.
Awesome, man.
Yeah, so I started off with the very sales-focused sort of culture and learnt the ropes there, and was there for about 5 years, and have since ventured out on my own and started my own business, Peak Wealth Management.
Fantastic. And I guess, a lot of people watching this here, property investors or soon-to-be property investors, exploring options, learning. How does the world of that, financial wealth management and property come together?
Yeah, good question. I think the property side of things can come into a couple of forms, or a number of forms. I think personally, I have a lot of discussions around own homes. So a lot of people are looking to purchase their own home and want to understand the best way to do that. What are the things they should and shouldn't do? The ins and outs, and they just really want to get an understanding of that. The other side of it is, and I do a bit of this as well, is clients looking at wealth accumulation and using property as a wealth accumulation sort of vehicle. So property comes up all the time. Australians have a fascination with it, and it's always a discussion point. And if you're an advisor that doesn't really have those discussion points and discuss that sort of stuff, you are a bit behind the eight ball.
Yeah, I think that's one point you mentioned there, because there's some people that go into an advisor discussion who go, I'm really looking for an open conversation with someone to show me multiple things. Yeah. Then there's some people who go, well, I'm going in this conversation, I hope they just don't tell me not to do property, right? Yeah. I mean, how do you have those barriers in front of clients, and how does it come off when working with you? Yeah,
good question. So I think the way I sort of do it is really understand the reasons behind they're doing what they're doing, all right? So if someone comes to you and goes, yep, I want to purchase a property, then next minute they go, look, in 3 years' time, I do want to relocate overseas and don't see my foreseeable future in Australia or in Sydney, then property probably isn't the right asset class for them, because that's very short-term sort of focus. And maybe you look at another investment, whether it's a managed fund or some shares or something like that. So I think the point I'm trying to make is that you really need to understand what the client's initial goals are and what they can, or where they can see themselves in the foreseeable future.
Yeah, so it's a lot of personalisation rather than going, hey, no, property's a no-go, or property
exactly
this
right.
sort of thing.
Yeah, no cookie-cutter approach on that sort of stuff, right?
And people who might be, looking at this and listening and going, hey, what does a financial planner actually do? What's the simplest way you could explain that?
I think the simplest way is, keep it really simple. It's understanding what your goals are, helping you achieve those goals in the quickest time frame possible by taking the least amount of risk.
I think that's really well put, mate. Really well put. And with risk, I think that's one thing in the property world as investors. a big red balance that shows up pretty
Yeah,
much every time
always.
you buy
Yeah.
something, right?
Yep.
You have the balance in black or the green, how you call it,
Yep.
and that becomes the zero in most occasions, or a little bit left over,
Yep.
and then you're going all red, you know, and in some cases, depending on where you buy, up to the eyeballs, right?
Yeah, exactly.
So how does that risk management come into play when people are talking to financial planners, and I guess what are the sort of strategies that come into play for that?
Yeah, great question. Couple of things I look at, and I'm pretty big on this, is I do like to keep a decent sort of cash buffer. So I'm not an advisor that's going to promise you you're going to get rich very quick. I'm more of a get rich slow sort of person. And in saying that, even sometimes when it comes down to those strategies, I will discuss doing principal and interest loans as opposed to interest-only loans, even for investment properties at times. And I think at the end of the day, like, paying off debt isn't a bad thing. So I'm all for it, really. But I think it's really about understanding the client's cash flow and understanding, all right, if things do change, if you lose a job, if your wife gets pregnant and she's off work for 6 months, what is that going to look like? What is that strategy that we're looking to implement going to be? All right, and how can we be able to continue that strategy or in the same trajectory and not be affected negatively along the way?
Right.
So it's all about really understanding the client's current circumstance, but also potential future circumstances as well.
Right. And how does insurance come into the picture of these things? Because I know that's something that's often talked about in the financial planning world.
Yeah, it is.
Because with that red balance comes what happens if X happens, what happens if the job, or what happens if someone passes. All these things, I know, touch wood, they don't happen to anyone, but they do happen. Right?
Yeah, of course. So,
what are your thoughts on how the insurance comes into play for people?
Yeah, I think insurance is a big part of it, but I think it's also it's not just about the property. It's about everyday life, really. So I like to use it as a risk management tool. I don't like to use the word insurance. I call it a personal protection plan or a family protection plan.
Feels better that way.
It does feel a little bit better. Yeah. But yeah, it's a very very important piece of the puzzle, and I'm quite passionate on that. I think in order for clients to enter into some form of investment and borrow money, it is important to have that backup plan should something happen, and I think if you look at that, there are ways that we can protect the clients for both short-term situations or scenarios and also long-term scenarios. So we're looking at the full suite of stuff: life insurance, permanent disablement, income protection as well, and also crisis or trauma cover for those one-off events which can take a big toll on everyone.
So I think that's really well put, because of it's not just property, but it's life.
It is life,
and I guess you save via an income to get a deposit.
Yep.
Then you have a deposit that you don't want to live off at any point. You want to use that for investing.
Yeah.
And then when you invest, you don't only have an asset, but you have also a income that comes from it and a debt that's with it, right? So I get where you're coming from.
Yeah.
I mean, for those different insurances that you've mentioned, I guess in simple terms, what do each of them do?
Yep. Great question. I guess just one point I thought I would touch on would be with regards to those insurances. People always think, I've always got an asset behind me at the end of the day, like I've got a property with a significant amount of income or a significant amount of equity. One thing I want people to recognise when it comes to those insurances is that most of the time, the biggest asset that people have is their ability to earn an income. If you multiply that over such a long period of time, it is the biggest asset, and there's no reason why you wouldn't want to protect it.
That's a good point.
But just to summarise the covers, there's four main sort of cover points which I look, which my clients typically and probably your clients would look at taking out. The first one would be life cover. Pretty self-explanatory. If something were to happen to that person or individual, there would be a lump sum money paid out to either the estate or the surviving spouse or kids.
Yep.
The second one is total permanent disablement. That is cover that would cover that individual themselves, lump sum amount in the event they weren't able to work again.
Okay, gotcha.
Okay. Third one is your income protection. So you can only protect 75% of your income. The reason why it's not 100% is that the insurance companies want you to go back to work again. And the fourth one is trauma insurance or crisis insurance, and that's covering traumatic cases or traumatic incidents. Good examples of that are cancer, heart attack, or stroke.
Okay, so it's like a mixture of long-term incident,
Yep.
one-off incident,
Yep.
life, and then your regular income, right?
Income
gotcha.
support. Yeah.
I guess I know we're on insurance for a little bit here, but I mean, I'm trying to understand when's the right time, when's the right amount of debt, when's the right amount of thinking, because I think so many people. Maybe there's a lot of people that don't understand the importance.
Yeah.
Maybe there's a lot of people who do.
Yep.
But they're just stuck on when,
Yeah.
right? So when in your eyes do you feel is that right time? Because there are some people I know who their lives are changing rapidly. Like
Yeah.
I'll give you my example. I went through a rapid, income changing over years, asset changing, debt
Yep.
changing,
Yep.
and there might be many others like me who've done that, but there might be people who do it at a slower pace.
Yep.
So when you think about all these different things, I know there's not one clear answer, but I mean,
No.
what do you think in terms of that timing?
The answer I'll give you there is probably yesterday.
Yeah.
I think when it comes to this sort of stuff, right, as everyone's got goals and plans that they want to achieve in life. Now, if one of those things happen to you at that point, you're not going to achieve those goals or plans. And I think, insurance is there to allow you to live some quality of life and achieve some of those goals and plans over that long period of time. So irrelevant of how much debt you've got or irrelevant of how many assets you've got, I think there is also always that little bit of peace of mind that insurance can provide you, that if something did happen, you're still going to be able to achieve those lifestyle and financial goals, really.
Yeah. So it's sort of like don't sit around waiting for something to happen, right?
Exactly right.
And some things we commonly hear is like, oh, well, I've got super. I mean, when does that work and when doesn't it work? Because the truth is, most people probably have some sort of insurance covering the super.
Yep.
And they usually go, oh, I'll sell it. I've got super. How does that come into the equation?
Yeah, well, I guess the first thing is all that insurance inside super fund, you do need to meet a condition of release to be able to access that. So a good example is if it is a little traumatic incident and you might be off work for 6 months but then go back to work after that 6-month period, you won't actually receive any money because you didn't meet a condition of release.
Right.
All right, because you've gone back to work. So a couple of things
6
there.
6 months is a long time as well.
It is a long time, but you have to, the condition of release means that you have to not be able to work again to be able to access that money or claim on that insurance inside that super fund. All right.
Right.
The definitions inside those super funds are also very important to think about. For example, total permanent disablement, which a lot of people would have, is an any occupation definition. And for you to claim on that, you can't do any role. You have to not be able to do any role.
So it's
right?
I get you can't work in your job, but
Yep.
could you go do that? Oh, well, yeah, then sorry. No,
Yeah, that's it.
wow.
Exactly right. So if I pick on myself, something happened to me and I had I couldn't function cognitively anymore. I can't do my current role, but I could potentially do a manual role.
That's interesting, right?
Yeah.
And so I think, thanks for touching a lot on the protections, because it also makes me think about, let's take home insurance for an example.
Yeah.
For home insurance, many people, I'm just going to throw out a made-up figure, 90% of people probably look at the dollar it costs and go, if you can beat that, I'm yours.
Yeah, exactly. Yep.
What are the dangers people have when they go down with that mentality on this type of protection or these type of protections?
Oh, the definitions would be the huge thing, and sometimes if a product is significantly cheaper than another, there could be certain exclusions in that policy which you won't claim on, and those exclusions could be, it could be very likable or very claimable sort of things. A good example, and this is something that a lot of people don't know, is a lot of insurance companies in Australia at present, with income protection, don't actually make any money on those insurance policies.
Wow.
They lose money every single year.
Wow.
All right, and there's places in the world where they don't even offer income protection anymore. So there's a lot of things that people don't recognise of that, but there are a number of different ways you can actually claim on those policies, and you want to make sure that you've got policies that are the strongest definition. So in those events, in those unforeseen circumstances, you are able to claim on them, they do their job, they do their role.
And would you say the planner is your partner in the whole magnifying glass on the definition, and then also being on your side when that time comes, if anything like that?
Yeah.
Was that the best way to say?
Yeah, certainly,
Yeah?
certainly. I think the majority of planners out there are strategy focused, and what their goal is to understand what you want to see happen in those what if scenarios, and work out a strategy on which is the right amount of cover and also the right product for yourself.
Okay. Yeah.
Right.
Mate, I mean, thanks for covering a lot of info on that part.
Pleasure.
The last one I might throw at you is, okay, shares is a big part of how many managed funds and how many planners support, investors in the whole portfolio.
Yeah.
But I'm pretty sure there's more to it than just shares, right? There's a whole bunch of assets. And I know from the common eye, it's usually shares or property.
Yep.
But if we try and bust that myth and go, what else is there? What else is there that a planner supports you with people that people might not know?
Yep.
How about you share a little bit about that?
Yeah, cool. I think so. When you look at it, when you are building a portfolio, there's 5 main sort of asset classes which you would look to include when building a sort of bespoke portfolio. Property is certainly one of them. Shares, we can probably break it up into 2 components, and that's Australian shares and then international shares.
Yeah.
You've got a fixed interest, which is something that a lot of people don't really understand or know about. But fixed interest is essentially, it's not term deposits in the bank. It's more so a thing called bonds.
Right. Yep.
Mentioned. So they're just debt facilities that corporates or governments can use to raise a bit of money. And then you've also got your cash, which everyone's got a bit of, and everyone should have a bit of at every particular moment, especially as an emergency buffer. And the other one that's something that gets missed quite a bit is also infrastructure. So you can invest directly, or sorry, not directly, but you can invest into infrastructure projects,
right?
Or even companies related to infrastructure investments. So yeah, it's another little niche there, and it's a good little strategy to assist with any downside.
Mate, that's interesting. It just shows how broad investment is, right?
Yeah.
And if people are wanting to get in touch with you, Andrew, how can people get in touch with you with regards to what you talked about today and the knowledge you have across, protecting people who are investing, finding alternate solutions, and just knowing what else is available? Yeah,
look, I'd love to hear thoughts from people as well. But best way to get in touch with me would either be on my email, andrew@peakwm.com.au, or give me a buzz on my personal number, 0434 955 417. Or feel free to reach out on LinkedIn.
Awesome. That's it from another episode of InvestorPool. Thanks for tuning in.